This is Digital Perspectives with Brad Kimes. Subscribe for new content notifications. Now, here's Brad Kimes. Come on in.
Welcome back to the show, everybody. You know what time it is. We got the one and only Cryptopolis in the house. How are you, Dave?
I'm doing great, Brad. How you doing?
I'm doing really well now because we're going to get into a great conversation and we're going to try a different format for people to know too. We're shortening the format a little bit and we're kind of hyper focusing in on some specific topics today, and that's going to be a lot of fun. And we're going to start with the 1929 playbook that we have looked at often on this show, but it's still on the table, isn't it, Dave?
Yeah, so back in March, when we had the big crash in the stock market, right, and in cryptocurrency, they kind of went together, and there's a reason for that we can talk about. But after that, I said, you know what? I think we're, we're on hold here for the 1929. So we needed a rebound, and we got it. So about a month and a half ago, came back on. I said, hey, this playbook is back on. The 1929 playbook is back on because we're seeing what I think is a volatility event, very similar to what happened in 1929. We had a sharp sell-off, a rebound, and then a resumption of the decline. And I think the same thing is going to happen in stocks again. And we're starting to see that a little bit this week, right? We're down close to 2,000 points on the Dow, which, in the big picture is not much yet, but I think we're going to revisit that low that we had back in March down around 18,000, and I think we're going to exceed it to the downside. That's just my opinion, not financial advice, but everything I'm looking at right now certainly does indicate that. And a shout out to Stephen Van Meter, who we had on last week. He did an absolutely fantastic video on Monday, which I highly recommend everyone go take a look at. The title of that video is Banks Are Still Looking to Crash the Stock Market.
Absolutely. It was amazing having Stephen Van Meter on this show. It really was. I mean, He has so much knowledge in breaking things down. I thoroughly enjoyed his perspectives. Now, there was quite a few comments in that video where the crypto investors in this space were like, hold on, Stephen, now there's another asset other than Bitcoin out here, But it was just great to hear his insights on economic outlook and economy in general, and the perspectives, honestly, that he shared, I had never heard delivered the way he delivered them. And it was...
Yeah, he's a macro guy, and he really has a very, very good handle on it. And I have to appreciate him a great deal because he filled in a couple of holes for me. Yeah. And I had a fairly good grasp of macro events. And he really just there was a couple of little holes I had, and he filled them in because I'm a trader. I'm not a macro guy generally, but I have to follow macro, right? Yeah. And he filled in some holes that were really, really important. And in this video that he did last Monday, he really hammered home the fact that tightening of lending standards, which is happening right now at the banks, is likely to cause bond prices to go even higher and the stock market to go lower. It's the same thing that happened in 2008, and it happened in the dot-com crash and to a lesser extent back in 1999 and 2000, but it's even higher now. And so we really have to pay attention to this. I think there's a lot of interesting things coming down the road. I think this election is going to be a big question mark because even after the election is over, and from what I read, 80 million people have already voted in this election, right? Mm-hmm. So we're going to get a pretty good sense of what the results are going to be. But I don't think with all of the paper ballots that have gone in, it may be days, weeks, even a month or more before we actually get to find out who is the next president. And that's going to put everything on hold until January 1st. If we know by then, just imagine what's going to happen if we don't know by then. But, whoever wins at that point, we're kind of in this limbo until January 1st, really. It could happen, and that could have dramatic effects on the markets.
I think so too, and I mean, what you're talking about. My mind immediately goes back to the hanging Chad. You remember the hanging Chad and the counts and the recount in Florida. It literally got down to a piece of paper, and whether or not the tab that was punched through was fully in the floor. I mean, this was just. I mean. You can't make it up. It held the election up, right? I mean, the counting of the vote, a hanging Chad.
Yeah, so, I equate it to waiting for Godot. So it's just like, hey, is this guy ever coming or what? It's just not happening.
I know it's unbelievable, right?
But pass the time, and
it really is. So going back to a point that you made here about the 1929 playbook, because I want to stay here for just a second for people. And if you could talk about, because what you're talking about is the traditional markets and looking at the Dow Jones and these numbers are coming in and you're seeing the volatility the way you saw it in 1929 and it repeating itself here. And literally the size of the bars, the trading activity, the buying and selling off becoming very, very volatile. Can you just talk about that a little more here?
Yeah, so I'm a student of volatility. I am all in on volatility. I believe that drives the stock market. And what happens is that when we have a volatility event, and what I mean by a volatility event is a large move in the market in proportion to where it was. Yeah. So if we get very small daily changes in the Dow Industrial Average, and all of a sudden we get an expansion, which is a 2, 3, 4 sigma event, right? We get something that's really, really large. That tells me something. It tells me that there's a great deal of fear in the market. There's a great deal of exits to the, going through the fire door. If you're in a theater and the fire breaks out, well, people are just rushing to the doors to get out, right? And that's what happened in March. The very same thing or very similar thing happened in 1929. We had an absolutely incredible decade. From 1919 to 1929, the stock market was going up like crazy. And it wasn't really until very, very close to the end of 1929, it was September 3rd, 1929, was the very top of the market, where everybody was so hopeful. Everything was great. Everything is just like, wonderful. And all of a sudden we had this huge volatility event where stocks just absolutely crashed. And people were liquidating their positions. Now, one of the similarities here is that in 1929, very late in that cycle, as we got closer to 1927, 28, 29, retail investors just plowed their money into the market hoping to get rich, right?
Yep.
The same thing happened after the crash we had in March in the markets. We had this extreme rebound, a V-shaped rebound. And in that rebound, retail investors have been invested in this market to an extent we have not seen since 1999, when retail investors were in the dot-com, rise in the stock market in technology issues. So that is very similar to what happened in 1929. The big difference in 1929 was you could buy stocks on 10% down. So you had 90% margin.
Okay.
So that's a big difference. Now, there is a similarity here to what happened recently, is that as stocks have started to come down here over the last week or so, we're down 2,000 points. Instead of selling their shares, retail investors have borrowed against it. So they're actually borrowing more money. They're trying to take cash out of the market, not by selling, but by trying to get more margin on their stocks. And so now they've leveraged themselves up to the highest point since 2008 and 1999. They are leveraged beyond belief. And so what happens is we have this large volatility event in March. We have a rebound just like we did in 1929 and 1930. And now we're going to see a second leg down, most likely, because retail investors are all in. Similarities to margin, they're borrowing against their stocks rather than selling it because they think this is temporary. And I hate to say it, but retail investors are almost always wrong.
Yeah, and I'm showing them right now a still image of the video you did of this 1929 playbook and showing the 1929 image versus today. And just for the viewer, really quickly, I want to show them what I'm pointing to now is the height of the 1929. And I mean, that's one hell of a volatile melt up to that collapse in 29 that I'm looking at there, Dave. And
Absolutely.
man, what a crash. And then you see that rebound, that V-shaped spike back that comes back where everybody tries to, get the market and push it back up again. And then obviously we had this enormous run down. I mean, my goodness, is that a long run down? And
yeah.
Then you see coming here to where you're pointing out to today, you see the March collapse there. We see everything collapsed there and March went down. Then we see this, coming back up again, just like you talked about here. And potentially where we are at the end of the chart is looking at the potential of repeating that downside fall. That is just, and you can see the futile attempts that where people along the way down try to buy it back up and get it back up, and it just can't beat the sell-off. It's gone. And
yeah, well, there was an attempt yesterday at in the market to try to rally prices. At one point, the Dow was about 350 points. Right at the end of the day, 5 minutes before the close, it dropped about 200, so we ended up 139. But the futures dropped another 139 plus another 70, so it dropped 200 points right at the close, and it sets up for a very bad, technical picture for the markets right now. Look, I don't want to like be an alarmist at this point, but I'm going to say that, hey, look, based on 40 years experience in the stock market, I understand volatility very, very well. I understand what volatility does to the market, and it typically does not end well. And if you compare the volatility event in 2008, beginning of 2008 to middle of in March of 2009, that was a volatility event. And I compared it in that video to what we just saw in March.
That's right.
And it was tiny compared to what we saw in March.
Yeah, I'm glad you brought that up. I wanted to make a point of that, is that what happened in 08, 09 is really very small. It looks very small in comparison to what we're looking at. We're staring down the barrel of an absolute nightmare. And that is not to be an alarmist. This is what the charts are pointing to, right?
Well, yeah, and it's not just charts, but it is charts. You're right. Yeah. It is charts. It's just showing the volatility event, right? And those volatility events don't end usually very well.
Right.
They carry on, but there's been a little bit of a relief rally recently, and I think that's coming to an end. But even so, there is fundamental changes in the economy that could drive this even further. Of course, we could get into all the fundamental reasons. The health situation is just huge. We've got the biggest thing, and this is this thing that Stephen Van Meter brought out in his video, is that the banks are tightening lending standards. And when that happens, we get not only an increase in volatility, a second leg up, but we also get a very large decline in stock prices. Absolutely. Which, the banks are preparing for. It's the retail investors that have piled into this rally. It's the banks that have taken the other side of this, and they really are the smart money here.
Yeah, and it's funny, too, because whenever I see, going back to the 08-09 crisis, and I was, as well as a professional musician, I was also a real estate appraiser and a property owner, that was doing commercial property and things like that, real estate and landlord, renting property and things of that nature. And during that time, when you saw that shift, that paradigm shift from the banks and change that credit, structure to where you had to be here now to get that same loan that you could have got before.
Yeah.
This, it's almost like the moment before they start pricing in the bad news. It's like that step before the markets actually start to price in the bad news. And that's where you start to see these sell-offs that just are non-recoverable. Now, I do want to preface things for people that, obviously the charts are a reflection of the markets and things of that nature. Rules are made to be broken, right? Nothing's a guarantee, but your years of experience point to this. But let's push it to crypto a little bit here. how do you see a moment in the traditional market like this affecting something like the crypto space and digital assets?
There's a very loose connection between the traditional stock market and cryptocurrency. It's not a direct one-to-one relationship or correlation here at all.
Right.
The crypto market is correlated very well to the US dollar.
Right.
It's an inverse relationship. When the dollar goes up, we see a little bit of a sell-off in crypto. But dollar is also going up because a lot of people are starting to liquidate their stock holdings. So there's a loose connection between the stock market and crypto, and in the middle is kind of this US dollar index. And so what happens is we see that when stocks fall, liquidation takes place, right? So whether voluntary or not, if the individual investor or the institutional investor wants to sell their stocks, they're going to put it into cash.
Yeah.
They're not going to go into tether,
Right.
like the crypto market, right?
Yeah.
So they're going to go into cash, and which increases the value of the US dollar. Now, in crypto, it's a liquid asset. And so when people are desperate for money, when they're desperate for cash, especially as a lot of the furloughs and the mortgages that have been deferred start coming back here, they're going to need cash again. And when they do, they're going to have to take whatever liquid assets they have and sell them in order to generate the cash that they need to live, to pay their bills and everything. And so one of those liquid assets, unfortunately, is the crypto market. They're very liquid. You get in and out very quickly.
Yeah, to your point, I've had several messages, and I'm not going to say who, but I mean, I've had several messages where people are feeling this, and they have expressed to me in direct messages they've had to liquidate a portion of their holdings because they're in a crunch and they need to get cash. They need to be liquid. And, a lot of this comes back to the deliberate shutdown of the economy. And, look, no one's trying to place blame, and fault and blame don't get you anywhere, right? But the reality is people have had this put upon them, right? And they've lost their jobs, or the hours have been severely reduced, or income, or what have you. And now they're liquidating some of their portfolio to just get the liquid cash they need to do day-to-day living. It's just unbelievable.
Right. So that's going to continue to happen, I think. If we see the stock market continue to decline, we see lending standards start to tighten up even more than they are right now. People are not going to be able to get the cash that they need. And, the first thing that goes is a liquid asset. Yeah. And so it's going to be stocks, it's going to be bonds, it's going to be in crypto, unfortunately. And I think that's going to happen. So I did an unpopular video about a week or so ago about the fact that I thought Bitcoin, as a liquid asset, is probably going to decline now. It did go up a little bit more, but I think we're starting to see the top of that. I said XRP has to hold 23 cents, or we're going to see much lower prices. It's right at 23.6 now. Yeah. So, I think that was an unpopular video, but I had to tell the truth. I mean, I can't sit here and say, hey, look, I think everything's great, Right. And I think a lot of YouTubers out there are trying to encourage or maybe motivate people to hold on to their positions. And I agree. I think if you're young and you're going to hold on to your positions, you got a long time span, but I would put it into quality.
Yeah.
That's XRP, that's Ethereum, some of the better utility coins.
Well, you make a very good point here, because we are at an inflection point, not only with the economy and where that's going and how it'll affect crypto, but we're at an inflection point for digital assets as a whole, because we're moving into a new watermark for crypto and digital assets, which is practical application, use case utility, right?
Yeah,
we're moving to that place. You're looking for those things, that interest you and really pique your interest to say, hey, I think this one has a chance, whichever one that is for everybody that looks at it. And so going forward, and just to wrap here on this thought, and then we'll do another segment too, but But just to wrap here, looking forward, what are like just one or two things that you're paying a really close attention to when it comes to either the economy or crypto moving forward here? What do you want to see, or what is it you're looking for that you really don't want to see but you know to pay attention to?
Well, I think most importantly, for anybody who's following the economy or crypto in general, is to have what I would call accurate thinking.
Right.
We don't want to base our assumptions of what's going to happen on hope that something is going to happen. We have to look at it in reality. And one of the things that I'm really looking at is the fact that the banks right now, the banks really control the economy. I mean, all the banks are in charge here, because the only time that we can get growth in the economy is if they're lending money. This is how new money comes into creation, as our friend Stephen Van Meter says. And so if they're not lending, if they're not out there lending, and instead they're tightening, well, why would they tighten? Mm-hmm. Because a lot of people just don't have jobs, and they're not going to get them back.
And they know it.
And there's going to be a huge change in the economy. You still have 40 million Americans that are unemployed, and how many worldwide is just insane. Yeah. And so people are not in a position to borrow money, and the banks are not willing to lend them money.
Yeah.
Because there's no positive outlook at this point, right?
Yeah.
And so they're going to tighten up their lending standards to only those with the very best. I mean, if you don't need the money, that's the time to go to the bank, right?
Yeah.
And so I'm going to be paying attention very, very closely to tightening lending standards and the 30-year Treasury bond, because what happens is in a tight when we get when we get tightening in credit standards, people are going to fly into Treasury bonds. And again, we are at a historic short position. People are short the 30-year Treasury bond, meaning that they think that the yields are going to go higher. They think interest rates are going to go higher. Instead, they're going to go lower because of the tightening lending standards. We're not going to get the economic stimulation that we need to drive the economy forward. It's just not going to happen. It doesn't matter who becomes president. It doesn't matter what the political situation is. It doesn't matter what what people think or hope. We have to look at reality here, is that there is no lending going on.
Yeah.
In order for people to really kind of go back into the lending market and start borrowing money, interest rates have to come way down. So I see the 30-year going down to almost zero. And that's going to create a tremendous demand for U.S. dollars. We're just going to see, it's going to be an event. But the good news is, after this event happens, I don't think we're going negative, because we are the world reserve currency. After this happens, my trigger point to get into crypto in a much bigger way than I am already, and into commodities, is when I see the 30-year go to zero, and then we start to shoot higher. That's going to be a trigger event for me to get into crypto in a big, big way. Probably all my holdings are going to go straight into crypto and commodities. Now, there is one other event going all the way back down to 1820. Every single time that the U.S. has gotten into a war of some sort, commodity prices have just shot up. And so if we go to zero on interest rates, and we have to have another military conflict in the world, that is a sure signal that crypto and commodities are just going to skyrocket.
Wow. Excellent, excellent insights and things to pay attention to. And I do want to tell people, when it comes to this, if the market is going to see more downside, make sure you know what you hold. Make sure you understand where you're putting your money. Vet everybody, YouTubers, me, you, everybody, vet us all, right? And make sure you understand where you are, because if we're going to have more downside, it's going to take a lot of intestinal fortitude to see it through. No doubt about it, Dave.
Well, Brad Garlinghouse made a very important statement last year, if you recall, and I'm sure you do, is that he said, hey, look, 99% of the crypto coins are going to go boom.
He sure did. They're going to go away.
They're going to go away. And so you be careful what you put your money into. Put it into the top coins that have real utility.
Absolutely.
Just
Dave.
my advice, not investment advice. You can pick any coin you want.
That's
Just
right.
do your due diligence.
Amen to that. Well said, Dave. All right, we're going to wrap this up and keep it short. I hope everybody enjoyed the video. Dave, thank you. Stick around. Don't go nowhere. We're going to have an offline conversation, and we'll catch all of you on the next one.
All right.